Hello, my name's Jeffrey Smith. I want to do a little short video here on buying a call option. Of course, there is risk in trading. Past performance is not indicative of future results. And of course, kind of a real simple rule here: if you cannot afford the loss, don't take the trade. There are two main types of options. One is a call option, one is a put option. We're going to be talking about call options. If you step back and think about what you can do in a market, you can either buy or you can sell. Of course, you can stay out, but that's not doing anything in the market. There are two types of people. There are buyers and sellers. So there are two types of options, calls and puts. So one of these is going to give us the right but not the obligation to buy, and one's going to give us the right and not the obligation to sell. Call options give us the right but not the obligation to buy at a specified price called the strike price. That's where we strike the deal on or before a specified date. When buying a call option, it gives the buyer the right to purchase the stock or the security at the strike price. When buying the call option, the buyer expects the underlying security to move higher. It's just like buying the stock, except we're going to be buying the option to buy the stock or the right to buy the stock. Of course, when we're purchasing a right to purchase something, we're going to have to pay something out. Whenever we buy anything, we have to pay money out. That's what they call premium. There's going to be premium involved in buying this option. So there's actually going to be a debit to the account. Whenever you go to the grocery store and buy a loaf of bread, you debit your wallet, right? So it's the same thing when we're going to go out and buy a call option. We're going to be debiting our account, but the call option on the stock that we're buying, we won't want that security, that stock, that underlying security, to move higher, because if it moves higher, it's kind of like buying the stock. If you buy low and sell high, you make money. If you buy a call option at, say, $1.50, and the stock moves higher, and the option value goes from $1.50 to $2, and you sell it, well, you make $50. So what we're wanting to do when we're buying call options is, in our analysis, see if the stock itself is going to move higher as well. The thing is, we can exercise our option at the strike price. That strike price is very important. If the option in a call option gets above that strike price, it now has what they call intrinsic value. Intrinsic value is real value, because if you exercised it, you would immediately make money. If you had a stock that had a strike price of $50 and the stock is trading at $52, if you exercise your option, you're now long that stock from 50. We can sell it at 52 and immediately make $200. So the higher the underlying security moves, the more the call option is going to have in value. If you're not at strike, say you're below strike, then the only value of the option is what they call extrinsic value. Extrinsic value basically is time value, the time left in that option till expiration that it can actually get to strike. So in either case, we still want the underlying security to move higher. A very quick example here on a call option. If you purchase a December IBM 140 call, that means you're going to be having the right to buy IBM at $140, and the December call would be the third Friday of December. That is the expiration day. Then the contract expires the third Friday of December. The strike price is $140. So you now have the right to purchase 100 shares of IBM at $140 per share. So that's what the call option gives us the right to do. Now, just very, very cautiously here, any call option that expires above the strike price, or what they call in the money, any call option that expires above the strike price can be exercised, or will be exercised on expiration day. Now, all options can be exercised at any time, but being the owner of the call option, If your call option expires above the strike price, then you will be purchasing 100 shares of stock. So if you do not want to own the 100 shares of stock, then you need to sell that call option before it expires. Next, we will discuss buying put options. Thank you.